Hello to all my trading warrior brothers and sisters. Let's have a great week. I want to start off with the dollar. Talked about fading it after the Fed, and that worked out fine. This was drive 2, and we held this 93 support. This is really the key for the market on the downside. Trading back under 93, I think, is going to set off the correction that my work says if that happens, we could fall all the way to 91. So we'll see. First, it has to do that. What it may do first is trade above the breakout level, 93.50. So if I'm looking to fade it, I'll let it do it, clean out the stops over last, I believe this was Thursday afternoon's high. Don't believe that the 2-hour will confirm here, and look for a reversal candle after we make this high. I already have a piece on in case it doesn't happen, because just because I desire a narrative, technical narrative to occur doesn't mean it will manifest, but if it does, I'm ready. So this is going to be important. Now, if we close above 93.50, you have to get out of the way. So, I'll probe it, and then if I'm wrong and we're closing, say, 93, 90, 94 even, that's where my stop will be. I don't want to be short the dollar anymore, because then there's something else going on. Should the dollar turn, it may give some relief to the pressure on equities, which we're getting this morning. I just want to show you guys a little bit of what happened in NASDAQ. So, I draw trend lines. I never know if they're going to work or be respected, but this was Friday's action. So Thursday night, I had the line drawn, and it pulled back right to this channel line. And we had a real nice rally Friday, closing strong. But, this is only 61.8 back of the total move. And now we're getting a trend line break. So, NASDAQ much weaker today, twice as weak as the S&Ps. And, I've always contended that mega cap growth does not like higher yields, and we're closing over 148. So yields are on their way up. This could end up being a major breakout in yields, and that's why the dollar may make another run. I can say they're getting a little overdone over here, but this is first, the 137 was something I said we're breaking out. Now we're following through. You might get something counter trend in yields, but to me, it looks like we have another wave in force that maybe can attack the highs that we made last spring, all the way back last spring around the 178 level. I do expect pullbacks there, just like the yen is getting overdone. But when I look at the yen, it's much clearer on the weekly. I talked about it once we started breaking out over the 110 level last week, that now the third drive scenario is on in the yen, and we could push up to 112.50, which will still mean higher yields and will still mean lower gold. So here's the gold market. Really hasn't done anything that tells me I want to buy it. It's not, in fact, it looks still vulnerable. And if we head down to 1680 and crack it, you'll start hearing numbers of like 1500 gold, 1450 gold. So as long as the yen is in a bull market, gold will be in a bear market. And right now, when you look at the yen, let's break out our telescope and look at a monthly chart, because it is all about yields too, that we're coming out of a huge triangle, right? So we've been in this triangle since 2015. So 6-year triangle that we're breaking out of. We can make a run towards the highs. You look at the monthly was confirmed coming off a straight line move. So, it's always good to get your telescope out so you could see the forest from the trees. So we had this huge rally in the end from 2012, and really have only corrected this. Okay. I mean, basically moved sideways, got oversold in 21 down here at 102. And looks like we could have some type of bull market working here in the yen, which is Normally the correlation is negative for gold, and usually means also the correlation is for higher yields. So I see no reason to short the end, maybe take profits if you bought it near 109. I'm always a believer in partial profits. Looking at Aussie compared to Euro, uh, held last week's low. Sure was a nice give back, but Aussie still looks like it's basing. I think you could buy it with stops under 72.20. That's not a big risk in FX. So Aussie looks good to me. I wanted to talk about the NASDAQ again and talk about what's going on in China. And, you know, it's not just going to be evergreen. China's debt to GDP is the biggest in the world, like 230% of GDP, all the debt. Just interviewed a guy from Europe that told me that real estate values have already fallen 50% in China. They're trying to manage this deleveraging. I also think it's strategic that they're willing to go through austerity and take the hits with all the artificial debt that's been created. Remember the ghost cities they used to have. And I guarantee you that there are some, there is exposure across the world to if China goes into recession. In fact, you know, I don't think economists can have it two ways because you know, I have a memory. And I remember going back to 2008-9 during the Great Recession and the housing crisis. China didn't own a lot of that paper and those derivatives, and they didn't have a real estate crash, and they didn't have to bail out their banks. In fact, they were still growing, and the narrative back then was that China will be a growth engine, an engine of growth for the world economy to drag us out of recession. So you can't say, and that was, you know, 13 years ago, and China has grown quite a bit since then. So you can't say that China can pull us out of a global recession and then being 1/3 of global GDP, which China is, have a deleveraging, self-inflicted, managed recession in China without it affecting the rest of the world. They used to say, and this is when you know, the U.S. was still China was still way behind in economic growth terms to the U.S. And there used to be an expression that if America caught a cold, the rest of the world caught pneumonia. Okay. So if China has pneumonia, not a cold, pneumonia, don't you think America could at least catch a cold or sneeze with that going on? Well, I think that they are, you know, for years, everyone's talking about black swans being the reason for one more swoosh to the downside in asset prices. And I don't think it's going to, I think they have the wrong animal. It's not a black swan. It's a red dragon, which is China. So I'm not so sure the Fed's going to be able to, they'll try and offset it, but you know, they will go ahead with the taper for a while. But if I'm right about what's happening in China and what it means for global markets and the global economy, the Fed will most likely reverse from tapering after a while and give it a go to try and offset weakness coming out of China. So just wanted to you know, give you my explanation for why I think Evergrande is just one issue that's going to come out of this. They're trying to manage it. It's at least they decided on their own to end it. But I also think there's some strategic value in what they're doing because, you know, we are in a Cold War with China. And let's face it, the wealth effect is what's really helped the U.S. come out of both the Great Recession with people feeling good about their house values going up and their 401ks going up. and it's been a big part of the recovery and the wealth effect. So I would say that the Chinese population is used to austerity. I mean, for decades and generations, they didn't have much before this recent expansion, and that Americans, as you can see, were screaming for checks during the COVID crisis, and we're not really good at doing without. So if in the course of managing their own deleveraging, it could create some problems in the financial markets for the US, I think that's part of the strategy as well. So we've covered the currencies. We're going to see if the dollar index can take out this high and what kind of spike we're going to get. What I'm looking for right now is a break above and then a close back underneath it to go with it. Okay, so maybe it's a turnaround Tuesday play. I'll be back with you tomorrow, but I'll be with Michael, but I'll give you an update on this. I also want to say what gives me, sometimes you need something to hang your hat on when you're bearish a sector. And being bearish NASDAQ, I know I was early, but this is what I'm hanging my hat on, and it's Apple. And I talked about it when it was here up against the rising wedge, showed the divergence, showed the weekly 3 drive. There's your weekly, take a picture. Classic 1, 2, 3. It broke the wedge. And with the big rebound that we had last week in NASDAQ, it couldn't even rally back to 150. That's pretty weak retracement. What was this high? 57, 16 bucks. So 8 back would have been. So we didn't even rally 50%. Okay, that's a pretty weak rally. 17, between 38 and 50%. And this is going to be a major hurdle for it to get through. Maybe we're not even going to get there and we're on our way to making new lows. But I'm hanging my hat on that Apple is giving us a signal along with the averages finally that there's a correction coming in the S&Ps and NASDAQ. I think a natural place. Longer term, I think that Apple could see the $100 level, maybe 90, back to pre-COVID crash highs. I think that's a possibility. So until Apple really starts looking good, and I say to myself, Dale, I've got to buy Apple. I have to say that this Apple has a worm in it. Microsoft, which has been one of the stars, look at this today. We start taking out this moving average that we held. That looks pretty ugly. Facebook caved last week. Here you go. Nice divergence on the daily. It looks like a broken stock to me. So where's the strength going to come from? I know Netflix is still holding up, selling off right here, and Google had been holding up, but it's starting to look kind of vulnerable to me too. So I think there's a possibility that we've had the high in this stuff, and what happened last week from Monday's snapback low is just a corrective move in the market. We got to, pretty classic in the NASDAQ 100, the 61.8 level. Look at that. So we didn't quite get there last week, and now we have. So, we're on the verge. We could have a reversal week because we took out last week's highs. I know it's not, you can't see it because of all the fibs, but let me put this up and you can see it with, say, the spider. Sometimes my fibs screw things up, but the spider will give us kind of a look at what the weekly will look like here. Well, this is a daily, so it doesn't have an overnight market, but trust me, you have a reversal day in both NASDAQ and as well in the S&P. Looking at some of the Credit markets, LQD, corporates, failing rally, hasn't made a new high since the summer of 2020. Here's your junk bond market that people buy because they get higher yields. They haven't learned the lesson. The higher the yield, the higher the risk. And here's a look at DBA. It's a commodity index, thinking that everything's going to get cheaper during this washout move that we have. So QQQ rallied, rolling over as well. Now, if I'm right about the dollar, it should buy some time for the S&Ps, okay? And right now it looks like the dollar is getting ready to make this move, probably does it after the broadcast, so we're going to be watching that. But should we get a reversal this week in the Dixie from, after all the stops are taken out over 53, and then we start closing back under 50, and for sure, if we close under 93, you would think that a weak dollar, it usually means risk on, right? And a stronger dollar is risk off. So I'm going to be interested to see what if this scenario folds out and pans out, and we're going to get a correction to 91 in the dollar. I want to see what instruments and asset classes are supported by a weaker dollar. I suspect it might be commodities. It should be equities too. So first of all, we have to get the turn. And then what we're going to do is we're going to pay attention to the magnitude of strength with a weak dollar, because getting back to 91 could take several weeks if that's a scenario that's going to play out. So to me, this is a linchpin. The dollar is a linchpin. All the other markets are spokes on the wheel, and the dollar is a fulcrum. And we'll see if that correlation stands up. If we get a breakdown, it's going to be pretty bearish for everything. And if we get a breakout and we start closing over 93.50, we'll see. I'm going to take a shot thinking that there's at least some type of correction coming, but first they have to take these stops out, and they may not. And because they may not, I already have a short. I'm down, what am I short? 4 points. So I want to have something on just in case we don't have a stop hunt and start heading lower. So I'm a big believer in having partial positions, never go all in, never go all out. You piece it in, and at times you almost hope it doesn't happen right away. It gives you a chance to build a position. And when you're coming out of a trade, you always keep something on in case it turns into that windfall. You're not going to be there. And if you think you're going to be perfect on your entries and then perfect on your exits, you're going to be a very frustrated person with probably a bleeding ulcer in 5 to 10 years. So that's the focus of the week, is what happens to the dollar with the yields heading up. Are yields ready to take a little rest? Is the yen ready to take a little rest? And can they turn the dollar to cushion and support prices, because a lower dollar at least nominally supports prices. So that's going to be a very interesting thing to observe should this scenario unfold. If you like what I'm doing here, you could click the like button and subscribe, and leave a comment if you'd like, and also join us in main chat. So the other feature today is, we have this breakdown in the NASDAQ of this trend line. We'll see if it turns into just, a higher low down here and we rally again, but we could have something like this from here. And if this is a 3, say this was a 1, but they say it's only 3 waves. So call this A, B, C, and then we're up here for A, and this is B. C could be 1.618 of this in magnitude, and that would take us down, I believe, to the 14,000 range right about here, if we have 1.618 of the first decline. So join us in our chat room. You want to learn how to trade? I'm teaching it for free in here in TradeGate Hub. So I'm sure a few things that I show, they're going to help you. You know, it doesn't have to be complicated. If you notice my analysis, it may sound complicated, but you don't have to be a rocket scientist. If you can add and subtract, multiply and divide, and have the, let's call it the stick-to-itiveness. Jake Bernstein used to say that, to stick with something even though it's difficult, and put in your time. And in our business, it's screen time. I think that, it's a process. Don't expect to be an overnight success. It takes 4 years to get a degree in college. Anyone in a trade, an electrician, a carpenter, they go through being an apprentice and then a journeyman and then a master. So have realistic expectations about how long. I've interviewed well over 1,000 traders, and the average answer I get is 3 to 4 years before they really make a breakthrough and feel confident that they could generate a living from their trading. So learn from people that are better than you. I do that all the time. So NASDAQ making new lows as we speak, down 200 on the day. And this is looking, well, not new lows, but this is looking more and more like a failing rally. We'll see what happens. They're going to need a lower dollar to save this market. So that's a wrap. Don't just count your pips and count your shares, count your blessings. Our mission is to build up and edify traders every day. So come to TradeGate Hub.